interest rates going down, I just want to unpack that a little bit. That helped all asset values, right? It wasn't just private assets. If you look at a lot of the best vintage returns for any private equity class are back when interest rates were higher, ironically. As interest rates come down, a lot of the benefit of that goes to the seller of the asset, not the buyer of the asset. And then private assets, of course, have to compete with public markets for companies that need capital. It did mean that, however, that retail investors and other investors, I can't get returns. I have to move into private market. I have to reach for that illiquidity premium that we talked about before. So that was helpful. Having done that, though, people see how those assets have performed. They see how the returns have been good, and they see how they've protected capital in difficult times. I think that just feeds on itself. And I think that there's a reason why private markets grow at 10 to 12% a year. The most advanced investors were the endowments of the big universities, and they're at about 50% illiquid assets. Pension funds around the world, sovereign wealth funds, tend to be 20 to 30. Retail investors, high net worth investors, tend to be 1 to 3. And mom and pop investors, defined contribution plans are essentially 0. And what that says is there's an awful lot of room to move for more liquid assets for an awful lot of some huge capital pools. And those trends are happening. And I think a few things are happening. First of all, most investors have way too much liquidity. And if it was costless, that would be fine. The problem is liquidity has a cost, significant cost. And the cost goes up as the risk spectrum goes up. So for private credit, investment grade credit, you can earn 50 basis points higher with an investment grade private debt versus a publicly traded debt of the same duration and the same rating. As you go up the risk spectrum, core real estate, infrastructure, that premium gets to be a couple hundred basis points. When you get to equities, that premium gets to be 500 basis points. That's a huge cost compounded over time. So I think people are coming to terms with that. I think they're also seeing that private assets are not only less volatile, which is one measure of risk, but the actual realized losses over time are lower. So the way I see asset allocation in this environment is a few things. First of all, it makes me want to be in more secure markets, developed markets, Europe and the United States most particularly. It makes me want to buy companies that are not cyclical, that are rock solid, stable businesses with pricing power, and that are not capital consumers. It makes me want to look at hard assets. I like the secondaries market. Maybe we'll talk more about that later because you can reprice old assets. And what happens when there's times like this, you get bigger discounts. The move to credit markets is a big thing too right now. I think the secondary market is one of the big growth areas for private markets. As you point out, it's still small relative to the size of all primaries. And the more, as we talked about, these trends of more people putting more money in illiquids means you have more and more need for secondaries because there are people that want to rebalance their portfolios. They're not necessarily making investment judgments to get out of a particular private asset class, but institutions have denominator effects, so they become overweight in a sector. They have change of staff that want to redeploy, have a different investment strategy. Retail investors, they die or they get divorced or one thing or another. They need to sell sometimes. So what that means is just more and more need for secondaries. It's also just, for me, it's my favorite product. I love the secondary market.